In 1999, General Electric was the most valuable company on earth, worth $500 billion. By 2018, it had lost 90% of its value and was kicked out of the Dow Jones Industrial Average after 111 years. In 2006, General Motors was America's largest automaker, employing 280,000 workers. 3 years later, it was bankrupt. In 2008, Lehman Brothers was the fourth largest investment bank in America, managing $600 billion in assets. It collapsed in a single weekend. These weren't accidents. These weren't management mistakes or bad luck. These were the predictable results of a transformation that swept through American corporations starting in the 1980s. A transformation that replaced growth with extraction, that replaced building with borrowing, that replaced customers and products with shareholders and stock prices. And the terrifying part is this: the same structural weaknesses that destroyed these giants are now embedded in dozens of America's largest corporations today. Not because CEOs are stupid, because the incentive structure rewards short-term extraction over long-term survival. And once you see the pattern, once you understand the mechanism, you'll recognize it everywhere. Let me show you the three-stage cycle that brought down America's corporate giants, why it keeps repeating, and which structural warning signs tell you a company is entering the final phase. Before 1980, American corporations operated under a simple model. You built products, you sold them, you reinvested profits into research, factories, and workers. You competed by making better products at lower prices. Your time horizon was decades. Boeing designed planes that took 10 years to develop. IBM invested billions in research labs that produced innovations with no immediate profit. AT&T ran Bell Labs, which invented the transistor, the laser, and the communication satellite, technologies that wouldn't generate revenue for years. This model created the most dominant industrial base in history. By 1970, American companies led the world in steel, automobiles, electronics, chemicals, aerospace, and computing. They weren't the most profitable quarter to quarter, but they were resilient. They survived recessions, they trained workers, they built institutional knowledge that lasted generations. The companies were machines designed to operate indefinitely. Then everything changed. Not because of foreign competition, that came later. Not because of technology, that was an accelerant. The structure changed because a new financial doctrine emerged, and it came with a promise. You could extract more value from a corporation by cutting costs and returning cash to shareholders than you could by building products and growing revenue. This doctrine had a name: shareholder value maximization. And it had prophets, executives, and consultants and investors who believed that the only purpose of a corporation was to increase its stock price. Everything else was waste. The shift happened fast. In 1976, two finance professors published a paper arguing that corporate managers were agents of shareholders, not stewards of institutions. Their job wasn't to build companies, it was to maximize returns. By 1981, Jack Welch became CEO of General Electric and made this doctrine explicit. Every division had to be number one or number two in its market, or it would be sold. Managers were judged on quarterly earnings. Stock price became the singular measure of success. DGE became the model every other corporation tried to copy. Here's what that looked like in practice. In 1981, GE had revenue of $27 billion and employed 404,000 people. By 2000, revenue had grown to $130 billion, but employment had fallen to 313,000. The company had grown, but it was employing fewer people. Where did the money go? To shareholders. GE spent tens of billions buying back its own stock, which inflated the share price. It paid dividends. And executives whose compensation was tied to stock performance became extraordinarily wealthy. Jack Welch retired in 2001 with a $417 million compensation package. But here's what nobody explains about why this destroyed the company. GE wasn't growing by building better products. It was growing by buying other companies, cutting costs, and using its finance division, GE Capital, to generate profits through lending. By 2007, more than half of GE's profits came not from making jet engines or power turbines, but from financial engineering, lending, and derivatives. The industrial giant had become a shadow bank. And when the 2008 financial crisis hit, GE Capital collapsed. The company had to be bailed out, and over the next decade, GE disintegrated. It sold division after division. The stock price collapsed, and in 2018, It was removed from the Dow Jones after 111 years, the last original member. This is the pattern. A corporation stops investing in the activities that made it valuable and starts extracting value through financial mechanisms. It works brilliantly for a decade. Profits rise, stock price soars, executives get rich. Then the underlying business weakens, revenue stagnates, the company becomes fragile, and when a crisis hits, it collapses. Let me show you the 3 stages in detail, because this is the cycle that repeats. In the first stage, a mature company generates steady profits but faces slowing growth. It dominates its market. It has loyal customers, but the easy expansion is over. Revenue is growing at 2 or 3% per year, roughly in line with the economy. Wall Street analysts start asking why. Investors start demanding more. The stock price stagnates, and executives feel pressure. They need to show growth, not in 10 years, now. So they make a decision. Instead of investing in risky long-term projects, new products that might take years to pay off, they cut costs. They lay off workers. They close research labs. They reduce capital expenditures. They squeeze suppliers. Every dollar saved drops directly to the bottom line. Profit margins expand. Earnings per share increase. And because executive compensation is tied to earnings and stock price, managers get paid more for cutting than for building. This is the transition point. The company is still healthy. It still has great products, strong market position, talented workers, but it has stopped investing in the future. It's harvesting the past, and Wall Street loves it. Analysts upgrade the stock, investors pile in. The share price rises, and the executives are celebrated as brilliant capital allocators. Here's a composite example, not a real company, but a pattern you'll recognize. Imagine a major American manufacturer. Let's call it Apex Industrial. In 1995, Apex makes heavy machinery, construction equipment, engines. It employs 80,000 people. It has factories in 12 states. It spends 8% of revenue on research and development, and it's profitable, growing revenue at 4% per year. Investors are frustrated. A new CEO arrives in 1998. He's praised as a turnaround specialist. He immediately announces a restructuring plan. Apex will close 4 factories, lay off 15,000 workers, reduce R&D spending to 3% of revenue, and focus on core profitable products. The savings, about $1 billion per year, will be used to buy back stock and pay dividends. Wall Street applauds. The stock jumps 30% in 6 months. The CEO is featured in business magazines, and for the next 5 years, Apex's earnings grow steadily, even though revenue barely increases. This is stage 1. The company is consuming itself, but slowly, and the market rewards it. In the second stage, the company runs out of easy cuts. It's laid off workers, it's closed factories, it's reduced R&D, but Wall Street still wants growth. Earnings per share need to increase every quarter. The stock price needs to rise. And the company no longer has a vibrant underlying business generating new revenue. So it turns to financial engineering. This takes 3 forms. First, debt. The company borrows billions at low interest rates. It uses that money to buy back stock, which reduces the number of shares outstanding, which increases earnings per share even if total earnings don't grow. It's arithmetic, not growth. But it works. The stock price rises. Second, acquisitions. The company buys competitors or adjacent businesses, not to integrate them or create synergies, but to add revenue. Growth by acquisition replaces organic growth. The company's revenue increases on paper, but it's not building anything new, it's consolidating, buying market share instead of earning it. Third, accounting optimization. The company changes how it recognizes revenue, how it values assets, how it books expenses. Everything legal, approved by auditors, but designed to smooth earnings, to show steady growth quarter after quarter, even when the underlying business is stagnating. Executives manage the numbers, not the operations. Our composite company, Apex Industrial, enters this phase around 2005. Revenue growth has slowed to 1% per year. The easy cost cuts are done. So Apex borrows $3 billion, interest rates are low, credit is cheap. It uses $2 billion to buy back stock and $1 billion to acquire a smaller competitor. Revenue jumps, earnings per share increase, the stock price hits an all-time high, and the CEO's compensation package tied to stock performance reaches $50 million. But here's what's happening beneath the surface. Apex's core products are aging. Competitors, some of them overseas, are introducing better technology. Apex's market share is eroding, its factories are outdated, its workforce is demoralized. Research and development has been underfunded for a decade. The company has no major new products in development, and now it has $3 billion in debt, which requires $150 million per year in interest payments. The financial engineering has created the appearance of health, but the organism is sick. This is stage 2. The company is now dependent on borrowing and acquisitions to show growth. It's trapped. If it stops buying back stock, the share price will fall. If it stops making acquisitions, revenue will decline. It has to keep feeding the machine, even though the machine is cannibalizing the company. In the third stage, reality catches up. A recession hits, or interest rates rise and the company can no longer refinance its debt cheaply. Or an acquisition goes bad, something breaks, and suddenly the facade collapses, revenue falls, profits evaporate, the debt becomes unsustainable. The company announces layoffs, restructuring, asset sales, the stock price collapses, analysts downgrade, investors flee, and in the worst cases, the company files for bankruptcy. Not because of a single mistake, but because the entire structure was designed for short-term extraction and it ran out of runway. Let's return to our composite, Apex Industrial. In 2008, the financial crisis hits. Construction spending collapses. Demand for Apex's heavy equipment falls 40%. Revenue plunges. The company is still carrying $3 billion in debt. It can't make interest payments from operations. It tries to borrow more, but credit markets are frozen. It announces it will lay off 20,000 workers and sell 2 divisions. The stock falls 70% in 6 months. By 2010, Apex files for bankruptcy protection. The company that employed 80,000 people in 1995 now employs 25,000. Its factories are sold to private equity firms. Its brand, once iconic, is licensed to overseas manufacturers. The company still exists legally, but it's a shell. This is stage 3, the end state, and this isn't hypothetical. You can map this exact cycle onto dozens of American corporations over the last 40 years. Let me give you the real historical examples to anchor this pattern. I'm not predicting future collapses, I'm showing you documented history. Sears was America's largest retailer for decades. In 1990, it had revenue of $32 billion and 500,000 employees. But it stopped investing in stores. It stopped innovating. It started using its real estate to borrow money. In 2003, it merged with Kmart, another dying retailer. The merger was financial engineering, combining 2 weak companies to create the appearance of scale. It didn't work. By 2018, Sears filed for bankruptcy. It went from America's largest retailer to liquidation in 25 years, following the 3-stage cycle precisely. Cost cuts, financial engineering, collapse. Kodak invented the digital camera in 1975, but it didn't invest in the technology because it was profitable selling film. By 2000, it was clear digital would replace film. Kodak tried to restructure, but it had spent decades paying dividends and buying back stock instead of investing in new technology. By 2012, it filed for bankruptcy. The company that invented the future refused to invest in it because the present was too profitable to abandon. Toys R Us was America's largest toy retailer. In 2005, it was taken over by private equity firms in a leveraged buyout. The firms borrowed $5 billion to buy the company, then loaded that debt onto Toys R Us's balance sheet. The company now owed $5 billion plus interest, about $400 million per year. It couldn't invest in stores or compete with Amazon because every dollar went to debt service. By 2017, it filed for bankruptcy. The company didn't fail because of competition. It failed because it was loaded with debt to enrich its owners, and the debt made it too fragile to survive. These aren't aberrations. This is the dominant pattern of corporate failure in America since 1980. Companies stop investing in what made them great. They extract value through financial mechanisms. They become fragile, and they collapse when conditions change. Now let me show you why this keeps happening, even though everyone can see the pattern. Because the incentive structure makes it rational for every individual actor, even though it destroys the institution. Start with the CEO. She's hired to run a major corporation. Her compensation package includes salary, but the real money is in stock options and performance bonuses. If the stock price rises 50% during her tenure, she makes $100 million. If the stock stagnates, she makes 5 million. What's she going to do? She's going to do everything possible to increase the stock price during her tenure, which is typically 5 to 7 years. And the fastest way to increase the stock price isn't to invest in 10-year research projects. It's to cut costs, buy back stock, and make acquisitions. Those actions increase earnings per share immediately. The stock rises, she gets paid, and she leaves before the consequences arrive. Now look at the board of directors. They're supposed to oversee the CEO to ensure the company is managed for long-term health. But board members are often CEOs of other companies, and they're paid in stock. They benefit when the stock price rises, and they're evaluated on short-term performance. If the company's stock is rising, they're doing a great job. If it's stagnating, activist investors start demanding changes. So the board approves cost cuts, stock buybacks, and acquisitions, because those actions satisfy investors. Now look at the investors. Institutional investors, mutual funds, pension funds, they own most of the stock, but they're managing other people's money, and they're judged on quarterly performance. If they own a stock that's stagnating, their clients pull money out, so they demand growth every quarter. They don't care if the company is investing in long-term research. They care about earnings per share this quarter compared to last quarter, and if management doesn't deliver, they vote them out or sell the stock. Now look at the analysts. Wall Street analysts cover companies and issue recommendations, but they work for investment banks that earn fees from corporate clients. If an analyst issues a negative report on a company, that company won't hire the analyst's bank for future deals. So analysts are biased toward positive ratings, and they praise companies that buy back stock and make acquisitions because those actions are easy to model, and they boost near-term earnings. Every actor in the system is optimizing for short-term stock price appreciation, and every actor is behaving rationally given their incentives. But the collective result is that corporations are strip-mined. They're treated as assets to extract value from, not institutions to preserve. And here's the critical insight. This isn't about individual greed or stupidity. This is structural. The system is designed to prioritize shareholders over all other stakeholders, employees, customers, communities, future viability. And once you accept that the sole purpose of a corporation is to maximize shareholder value, you inevitably end up extracting value until there's nothing left. Let me show you where this doctrine came from, because it wasn't always this way. In 1970, the economist Milton Friedman published an essay arguing that the only social responsibility of business is to increase profits. Managers who consider other stakeholders, workers, communities, the environment, are stealing from shareholders. This idea wasn't mainstream, but Friedman's argument was embraced by finance professionals and business school professors, and it became doctrine over the next decade. By 1976, the agency theory of corporate governance emerged. Managers are agents of shareholders. Shareholders are principals. The goal is to align the interests of agents and principals. How? By paying managers in stock. If managers own stock, they'll maximize stock price, which benefits shareholders. This sounds logical, but it creates a perverse incentive. Managers now benefit from short-term stock price manipulation, even if it harms the long-term health of the company. By the 1980s, this doctrine was dominant. Business schools taught it, consultants sold it, investors demanded it, and a new class of activist investors emerged, targeting companies that weren't maximizing shareholder value. These investors would buy stakes in companies, demand cost cuts and stock buybacks, and if management refused, they'd launch proxy fights to replace the board. And they won, repeatedly, because institutional investors sided with them. The result was a transformation of corporate behavior. In 1980, American corporations returned about 40% of profits to shareholders through dividends and buybacks. By 2020, they were returning over 90%. In 1980, the average CEO held their position for 10 years. By 2020, it was 5 years. In 1980, CEO compensation was about 40 times the median worker's salary. By 2020, it was over 300 times. The corporation had become a vehicle for extracting wealth, not building it. And here's why this matters for the collapse cycle. When companies return 90% of profits to shareholders, they're not investing in research, in worker training, in new factories, in resilience. They're optimizing for this quarter, this year, and that makes them fragile. When conditions change, when a recession hits, or a competitor emerges, or technology shifts, they have no buffer. They've spent decades consuming their institutional strength. and they break. Now let me show you the structural warning signs that tell you a company has entered the final phase. First, declining revenue growth masked by rising earnings per share. If a company's revenue is growing at 2%, but earnings per share are growing at 8%, something else is happening. They're cutting costs, buying back stock, or using accounting tricks. The underlying business is weak. Second, rising debt levels with no corresponding increase in productive assets. If a company borrows billions but doesn't build new factories or develop new products, where's the money going? Usually to buybacks and dividends. The company is borrowing to enrich shareholders, and the debt makes it fragile. Third, a high percentage of executive compensation tied to stock price. If the CEO makes 10 times more from stock options than from salary, her incentive is to manipulate the stock price, not to build the company. Fourth, frequent large acquisitions without successful integration. If a company is buying competitors every few years but revenue per employee is declining, it's growing by consolidation, not innovation. And consolidation eventually hits limits. Fifth, abandonment of research and development. If R&D spending is declining as a percentage of revenue, the company has stopped investing in the future. It's harvesting the present. If a company is laying off workers while reporting record profits, it's cutting its way to profitability. That works for a few years. Then the institutional knowledge is gone and the company can't execute. Seventh, reliance on a single legacy product or market with no major new offerings. If a company derives most of its revenue from products developed decades ago, and it hasn't launched a major successful new product recently, it's living off past innovation. When you see 3 or more of these signs simultaneously, the company is in the extraction phase. It may look healthy, the stock may be rising, but the structure is fragile, and when conditions change, it will break. I'm not going to name current companies and predict their collapse. That's not the point. The point is to show you the pattern so you can recognize it yourself, and when you start looking, you'll see it everywhere. Large corporations across multiple industries operating on the same playbook that destroyed GE and GM and Sears. Cost cuts, financial engineering, debt-funded buybacks, stagnant innovation. The cycle is repeating right now. Here's what makes this particularly dangerous in the current environment. Interest rates were near zero for over a decade, from 2008 to 2022. During that time, corporations borrowed trillions of dollars at virtually no cost. They used that money to buy back stock on an unprecedented scale. American corporations bought back over $5 trillion of their own stock between 2010 and 2020. That inflated stock prices. It enriched executives and shareholders, but it didn't build anything. Now interest rates have risen. That debt has to be refinanced at higher rates, and many companies are discovering they can't afford the interest payments from operating cash flow. They're cutting costs further, they're selling assets, and some are starting to fail. Not because of bad products or competition, but because they're over-leveraged and fragile. Add to that the fact that many industries are facing technological disruption. Artificial intelligence, automation, electrification, these are fundamental shifts. The companies best positioned to navigate them are those that invested in research, in talent, in resilience over the past 2 decades. The companies that spent those decades cutting costs and buying back stock are not positioned to adapt, they're positioned to break. This is the terrifying part. The structural weaknesses that destroyed America's giants in the past are now embedded in dozens of major corporations simultaneously. And the macroeconomic environment, rising rates, geopolitical instability, technological disruption, is less forgiving than it was during the long calm of the 2010s. The fragility is widespread, and the trigger could be anything: a recession, a credit crisis, a major corporate failure that cascades. Now let me show you what this means for you, because this isn't abstract economic history. This affects your job, your retirement, your community. If you work for a large corporation, look for the warning signs. If your company is doing layoffs while reporting record profits, if it's borrowing heavily without investing in new products, if leadership talks constantly about shareholder value but never about customers or innovation, you're working for a company in the extraction phase. It may survive for years, but it's fragile. If you're invested in the stock market through a 401k or retirement account, understand that stock price appreciation over the past 15 years was driven significantly by buybacks, not by underlying business growth. Many companies are expensive because they've manipulated their share count, not because they're more valuable. When the buybacks stop because debt is too expensive or cash flow declines, those stock prices will correct. Diversification and caution are not paranoia. They're pattern recognition. If you live in a community dependent on a major employer, watch the signs. Corporate fragility doesn't just destroy shareholder value. It destroys jobs, pensions, tax revenue, entire regional economies. The collapse of GM didn't just hurt investors, it devastated Detroit. The collapse of the steel industry didn't just affect companies, it hollowed out Pennsylvania and Ohio. When corporations are managed for extraction rather than resilience, the communities that depend on them are collateral damage. Here's the broader truth. The doctrine that corporations exist only to maximize shareholder value has produced short-term profits and long-term destruction. It's made executives and investors extraordinarily wealthy, but it's gutted American industrial capacity. It's made corporations fragile, and it's created an economy where the largest companies are optimized for financialization, not production. This isn't sustainable. The corporations that survive the next 20 years won't be the ones with the highest stock prices today. They'll be the ones that invested in research, in workers, in products, in resilience. They'll be the companies that rejected the doctrine of shareholder primacy and built for the long term. But those companies are rare. Most followed the playbook. Cut costs, borrow money, buy back stock, enrich insiders, repeat. And that playbook has an ending. It's the same ending every time. Stagnation, fragility, collapse. The story of how America's biggest companies fell isn't about individual failures. It's about a system that rewards extraction over building. And that system is still operating. The incentives haven't changed. The doctrine is still dominant, which means the cycle will continue. More giants will fall. Not because they have bad products, not because of foreign competition, but because they consume themselves deliberately, systematically, rationally. And by the time the consequences arrive, the people who made the decisions will be gone, wealthy and celebrated. And the workers, the communities, the institutions, they'll be left with the wreckage. If this changed how you see corporate America, if you finally understand that the quarterly earnings reports and the stock buybacks and the executive compensation packages are part of a cycle that ends in collapse, then you're starting to see the structure. Subscribe if you want to keep tracking these patterns, because the next wave is already forming, and the warning signs are everywhere if you know what to look for. This isn't conspiracy. This is documented behavior, repeated across decades, following the same three-stage cycle: extraction, financialization, collapse. The architects of the system built it deliberately, and they're still running it today.